So let me get started. Just to recap where we were last time, we discussed this large and growing literature on growth accounting or development accounting, which basically tries to see if you could, look at the data and say that yes, the aggregate production function is a pretty good approximation to reality. We can explain most of the variation across the world by, a few inputs, aggregates. If I just put them in, I will get a pretty good fit. So the idea was that, I can sort of then say that, well, basically the whole world is on the same track, just maybe at different places, and once you add inputs, you will get to wherever other countries are. So that's sort of a kind of nice optimistic view. It turns out, however, that mostly it's very hard to pin it down. And it's just the data is never quite good enough to answer that question for a variety of reasons, including we don't know the production function for human capital, and therefore maybe they're complements, maybe they're substitutes, maybe different people's human capitals need to be combined in particular ways. And once you allow there are not enough data points in the world to kind of pick up the dimensions of variation available on this question. There's just too many possibilities and too few data points in a sense. In the end, I don't think we can resolve this question by just looking at the data. So that's one line of work. What I want to start with, so I will eventually, what I want to come to is a different way of addressing the question, to go more directly to it, to ask the conditions under which an aggregate production function would exist, are they satisfied in the data? I can look at it directly rather than going through this route of saying, can I absorb the variation in the world using this model? I could also do something else, which is say, look, this model has a certain set of assumptions. Are those assumptions satisfied in the data? You'll see that that has its own problems, but at least it's a complementary approach, and it does give us maybe a slightly better handle on the question. I don't think it's perfect, but it's maybe a little more effective than the other one. But before that, I want to take a slight maybe detour. And the point of the detour is a bit to set up for something I'm going to say in a bit, but it's also an interesting insight. So it's a useful one. It's a detour that's interesting per se, and that's this. So this is a paper by Lucas. Lucas is, if you don't know, is probably the most famous macroeconomist of the last 40 years or something. And this was his kind of a paper where he comes out and says, yes, macro is interesting, but the real problem in the world is not macro. Macro is just small relative to what's really important, and that's the variation across countries. But as a part of that, he wants to make the case that the aggregate production function approach cannot possibly work. So there must be an important omitted variable in there to explain the data. It must be the case that countries have just different productivities, and to make that, he makes that's the same point as Mankiw, Romer, and Weil were trying to examine, but he goes about it in a different way, and has one clever idea, or potentially clever idea, which may or may not be, which is going to be our kind of point of departure. The clever idea is, instead of let's forget about trying to measure capital. Just let's not do it at all. You remember we were measuring capital in an extremely kind of brave way. we were taking investment and then assuming steady state, backing out the capital stock from that. That takes some, you have to have real faith to believe that, but we don't actually, his point was we don't actually need to do that. So what he does is he's very, it's almost like a finger exercise. He's not really trying to get you to take this totally literally. He just says, look, I can do something that's going to impress you. In a sense, that's the nature of his exercise. He's not trying to say, this is exactly the truth. And that's, I think, a very good methodological point, which is that, at some level, what we're trying to do, to say that we can explain 76 or 78% of the variation using badly measured numbers on the left and badly measured numbers on the right, which may be subject to all kinds of correlated measurement errors, is a bit, small differences is not what we're after. It's just not going to be, we don't live in a world where we have that kind of precision. Let's see if we can get the order of magnitude right. That's his attitude very much, and that's a useful attitude to have, because in some ways I think some of these exercises suffer from setting the wrong benchmark. Okay. So what does he do? He takes a production function, he assumes that. Now, one of the things he doesn't deal with is human capital. He decides that basically we need to have big differences in human capital. Well, let's allow for big differences in human capital. And he mentions a study which I don't think was tremendously compelling, and says that, well, an Indian laborer produces only about a fifth of what an American laborer produces. This is in the mid-60s from agriculture, I think. The number is, I wouldn't put my life on that number, but his point was, in a sense, that this exercise is going to be not very sensitive to that. I could change that number by a lot. And in fact, we did an exercise where I'm going to actually do it slightly differently. I'm going to, we looked at slightly better numbers, only marginally better numbers for a later period. And the number we get is that. The reason why it's not going to make a very big difference is because we look at a later number, the GDP gap between the US and India that Lucas is trying to explain is also shrinks during that period. So the human capital shrinks and the human capital gap shrinks and the GDP gap shrinks, and those cancel out. So it doesn't make a very big difference to the calculation, and in a sense you could do it in 5 different ways. I could, I'll say where we do this. If I increase this number to, let's say, 5, I'll have a slightly less of a puzzle, but not much less of a puzzle, okay? So one thing, what he's trying to do is say, look, don't worry about the numbers. The puzzle is so big that it's going to jump out at you. That's a clever way to go about it, because in a sense, believing any of these numbers is so hard that it's better to sort of be a bit more, maybe a bit less kind of pompous about the whole thing. So that's what he does. He says, so instead of doing that, what we're going to do is we're going to take a slightly different number. Instead of 1/5, we're going to take a 3 1/3. And then what you do is you basically, you can just, because of this structure of this production function, when I think of each laborer as being, if one laborer in the US is 3 1/3 laborers in India, then I can just put that in here. I get 3 1/3 to the power of 1 minus alpha, which is 0.6, and I get a number which is roughly 2. So in other words, I'm going to now forget about human capital. I'm going to just adjust the differences in GDP by a factor of 2. Because I have an extra 2 that I got from the human capital. I'm going to say that, once I adjust for human capital differences, the GDP differences are scaled by that. So I have a smaller amount to explain and I have a smaller difference as well. The human capital is gone now. So what he does is really elementary, and you'll see why it's pretty robust as a result. He takes this this production function, differentiates it. It's trivial. That's what's nice about it. It differentiates it, sets the marginal product of capital equal to the interest rate. That's the interest rate. Okay, so the margin. This is the marginal product of capital. And now what I've done is I've taken this to be the. So sorry, I did one step here which may not be obvious, which is I replaced, instead of writing, I did something which people in growth do all the time, which is write this as exactly the same equation, which is a little k to the power of alpha. Okay. So now what we have here is the little k. In the next equation, what we're going to have is the little k. Okay, take that equation, invert it. What is the implied k? Invert this equation, take r as your parameter, invert this equation. If you invert this equation, you get a value of k. Plug that, so take that inverted equation, and you'll see that that has exactly this formula. So I'm going to, therefore I'm going to say the GDP per capita in the US divided by GDP per capita in India is going to be a sum function of the interest rate ratio and the TFP ratio. That just comes from taking this equation, inverting it. Once I invert it, I get k as a function of r, a, and alpha, and then I just plug it into the production function. Is that clear? So then his point is very simple. Look at this equation. Let's take this difference to be 0. Okay. Or rather, let's take this difference. We can take this difference to be 0, or we can take this difference to be 2, and which is what comes from the human capital, and then not scale this difference. So we can either take it out of here, scale the US GDP per capita by a factor of 2, because we already had a 2 coming from the human capital, or we can take this difference and kind of take 2, set it equal to 2, and you get this fact that since this difference is 11, this difference has to be 5. And in fact, it's almost exactly the same number. If I did this exercise by setting this difference to whatever it was in 1965 and take a bigger difference in human capital, it doesn't matter, it cancels out. Okay. His point is simply this equation, and this equation is pretty robust in the sense that suppose I were to increase, so if I set this, keep this fixed, and I made, let me increase this number by a little bit by saying that, you know, human capital is even more productive in the US. Yes, you'll get some more leverage, but maybe this number would come down to 3. The point is that the interest rate in the US should be, the marginal product of capital in the US should be 3 times or 5 times as big as that in India. And then his point was simply, why wouldn't capital, all of the capital in the US keep flowing to India? The marginal product is so much higher. Why do people invest in the US and not in India? So he says prima facie, this proves that it cannot be true. the marginal product of capital in India could not be 45%, because if it were, then there would be no capital left in the US. Capital would keep flowing to India. US doesn't invest that much in India. Therefore, there is no way this would be true. And what's nice about this argument is that he's not insisting on exact numbers. He's saying, look, order of magnitude, the interest rate differential, if it were very large, then capital would flow. And so if I fought with him and I said the numbers are not right and I got this down to 25%, he would still say the same thing. Look, it doesn't matter. Is that clear what the exercise is? So his conclusion was that the A's cannot be the same. So in other words, the aggregate production function without TFP differences could not explain the cross-country data. And this is using a different argument from the one that we were trying to use before. Yeah?
What about risk premia and transaction costs?
So let's come, transaction costs it's a fraught word because it means almost anything. So let me park that for a second. We'll come back to that. Risk premium, he discusses a bit and says, yes, there is maybe some risk premium, but if you look at the stock market risk premium in the US, it's not that there is no risk in the US. There is risk, and there's risk premium, and the risk premium isn't large enough to address this. He says something like that in his paper. It's just not the right order of magnitude. Okay, I'm going to skip a little bit because I think we'll come back to this. I just want to let me think for a second. Okay, hold that thought. Let me go through these slides. It will be quick. I won't spend too much time on it, but it's not useless to go through these slides. Okay, so hold that thought. Lucas' argument was the TFP differences have to be large because we cannot explain the interest rate differences. The interest rate differences cannot be an equilibrium. Hold that thought. I'll come back to that thought. Okay. Right now, let's go back to so now let's take as given that the TFP differences exist. Remember, the aggregate production function is really, the claim is really two separate claims. One is that there's no TFP difference, and the other is that there is an aggregate production function. We spend a lot of time talking about when an aggregate production function would exist. You had to make, markets had to function pretty well to get an aggregate production function to exist. So those are two kind of separable claims. I'll come back to talking about the connection between those two. But right now, just assume that all that we have to explain is the difference in TFP. So there's a whole literature which tries to explain just the difference in TFP, assuming that there's an aggregate production function, but just says, is there a difference in TFP? And the one argument that Agnew, Howitt, Paul Romer, Grossman, Helpman, all of them make, which is completely, obviously, prima facie right, is that, of course, there are technology differences across countries. So how could there not be TFP differences? That's not quite right. I mean, that's not what they say. They understand that, but the way I put it is not quite right, because some of that is just capital. Of course, the technology is different when I use more capital. And that's mechanical in a sense. What do I mean when I say I use more capital? I mean a different technology. So there's nothing that per se that's not a very informative claim. I think they want to emphasize is that even within the fact that the technology is different, there's actually some of the technology that's not being used in in many developing countries are not even available to them at the same price. And their point is, and this has a whole literature on patents basically backing it, showing that basically most patents come from a small number of countries. If you take the most concentrated thing in the world is patents. Very small, few countries have all the patents in the world. And so, related claim, all the innovation happens in these countries. The companies that own those patents have the latest technology, and they're monopolists on those technology. And because they're monopolists on that technology, they are able to extract lots of rents on that technology. It's their technology. You can't use it without paying them a bunch. But that has the implication that they are, you know, if you are in a developing country and you don't have the patent, then for you the same technology doesn't have the same price. The internal price of that technology to the one who owns the patent is much lower than the internal price to somebody, the external price of the technology. If I have the patent, then it's stupid for me to not use it. But when I want to give it to somebody else, if I give it to somebody else, he'll be my competitor. So I don't want to give it to everybody else. So I'm going to hold on to my technology and sell it at a monopoly price. All these papers and books are based on some idea like that. That the price of this technology is going to be higher than what the effective price of this technology to a company that has the patent is lower than it is to the people who have to buy the patent. That's core idea. There are many details which I'm going to skip entirely. But you shouldn't skip. If you want to learn this literature, you shouldn't skip it. I'm going to skip it because I have not much time to go through a very large literature. But the core idea is this, that the price of the patent, the effective price of the patent varies, therefore the adoption of the technology varies. So it's not simply, so if you have countries that can innovate for whatever reason, then they're going to have a different technology, they'll be more productive. Is that clear? It's very simple, that TFP will be higher. Now, I want to again look at that. Is that going to be enough to explain the data? So what do I mean by that exercise? So I'm going to say, I think if you take Lucas's exercise, go back to this exercise, if you made this difference 2 more, so let's say I was 2 because of human capital, if I doubled that, I would get much closer to closing the gap between India and the US. Can I justify doubling that based on kind of the data, on just the idea that, you know, these countries, India cannot use the latest technology because US has the monopoly on it. Can I justify that difference? Can I explain a difference of 1:2 just based on that? And I'm going to argue no. The answer is no, I can't. Because basically if you look at TFP growth rates in the US on average over long periods, it's of this order, 1 to 1.5%. Maybe slowing quite fast right now. So maybe if I take the later period after 1990, closer to 1%. So even at 1.5%, to double TFP, you're going to need 45 years. The problem is that most patents in the world are effective 10, 12, 14 years. After that, right now in the world, essentially they get reverse engineered in China, and China starts supplying the market with second generation machines which are 1 or 2 generations behind the cutting edge. but not 45 years behind. So that's prima facie a reason not to believe it. And I'll tell you a little bit better than prima facie. Just reasons it doesn't seem to me that, so I think most Indians would be using technologies discarded by the US in the 1950s. This is simply implausible because these technologies are not really, nobody fights to protect these patents. Okay, so this just doesn't seem right. Moreover, actually there's a bunch of studies by McKinsey Global Institute. What they do is they basically, some ways I think, do something quite useful. There are these reports, if you want to kind of study technology, these reports, they have global reports, Global Institute reports, national reports on India, Turkey, Egypt, many countries. These reports are quite useful as a source of information because they tell you about case studies of specific technologies. So why this technology, is it worth using in this country? Or this technology, is it worth using in this country? The economics behind it is often very shoddy. I mean, they're not economists, they're consultants, and they use, I would say, kind of, they don't think very hard about, what is cause and what is effect, and what's a true underlying difference and what's just a superficial form in the difference. But I think what they provide is still very useful and it's worth reading. I think it's not. So what do they say? Well, one of the things they say is that, so they do an India report. In the India report, I use the India report because Lucas is talking about India. You say that basically so they do a bunch of different technologies and different industries. So this one's from the apparel industry. Apparel means they make shirts or t-shirts or things like that. And the claim is that there's lots of technologies available which they do a kind of a counterfactual calculation, meaning this is the number of operators, skilled operators you need to operate this machine. This is how much they get paid. So if I just add up those extra numbers, this is the cost of the machine, this is the depreciation of the machine, this is the amount of number of skilled operators you'll need, this is the manager's time you need to, manage that person. And in some ways, I think that those things are all a little bit brave because you could get those numbers wrong, but they try to do a back of the envelope calculation, which is, I think, is still worth looking at. And their point is that these things are very profitable. Most of these machines, first point, these machines are very profitable, even at domestic prices. So what domestic, maybe skill is more expensive in India, so you don't use skill-intensive machines, but these skills are not that expensive. What's an example? An example is a spreading machine. Does a spreading machine do? Well, if you want to make shirts, the first thing you need to do is you need to cut the shirt. To cut the shirt, you need to align the pieces of cloth exactly, because you want to put 40 of them or 100 of them in one pile and then cut them all together. What a spreading machine does is it aligns them before you cut it. It's basically two rollers, and the rollers pull the cloth and they flatten it out. Okay? This is a very kind of basic technology. Has been around since the 1930s, I think, or 20s. So it's not a new technology, maybe even older than that, but it's very old technology. It's almost never used in apparel making in India. People cut it by hand, individual pieces. Rather, the claim is that most firms don't. So in fact, they make a slightly stronger claim. They make the claim, and maybe it'll come on the next slide, but in any case, I'm trying to go faster. They make the claim that it's not the case that there is no firm in India which uses this. Many firms do, but most firms don't. So in other words, the fact that many firms do proves that at the domestic price rates, it's viable. Right? The fact that there are a large number of firms that do it proves that at the domestic wages and prices, it's viable. You can make money doing it, but most firms don't. And that's the point they're making. They're making the point that, if you take the domestic prices, what do other firms pay on these things? You can make money using it, but most firms don't. Their point is that the TFP is low not because the technology is wrong, but the firms are too small. That they're just not big enough to use the technology. The problem is not that the technology is too expensive. There's lots of technologies that are basically economically viable in most developing countries, which are not used not because the technology is too expensive, but because the firm is too small. It doesn't have the scale to use it. So that's their constant. So they blame this lack of scale on the fact that this government regulation. They have a particular ideology. It's always government regulation. You know the answer from the beginning of what's the problem. But the point is still an important one, which is that they do the economics of it. They show that there is a bunch of people who use the technologies that are the most modern technologies. Within the same economy, there are plenty of firms that use the most modern technologies, but most firms don't use them. So that's, in other words, the claim very much, and this is useful because it sort of connects to something I'm going to say in a bit, that there is lots of diversity within the same economy in the technology being used, which argues against the view that it's really monopoly distortions that are stopping it. Because the technology, for the firms that use it, they're making money on it, otherwise they won't use it. Therefore, can't be a monopoly that stops you using it. It's something else that's stopping you using it. And their theory is scale, and scale because the government gives you incentive to have too small a scale. Okay, I'm going to skip this. So, do you see what the point I was trying to make? I was trying to say, if you take this, there's a whole literature which tries to explain the TFP gap between countries by saying that TFP gap must be a result of the fact that the technology is invented in other countries. The US invents technology, therefore the technology India has to buy it facing a monopolist, and a monopoly pricing of the technology is what? The constraint on adoption. And that just doesn't seem to be true. I think if you look at, it's true that there are many technologies that are owned by US, which are the cutting edge technologies, but the problem in India is not that it's not using the technologies that were cutting edge today. The problem is they're not using the technologies, most firms are not using the technologies that were cutting edge 20 years ago. Or 30 years ago. That's the problem. So that's not a problem that's going to be explained by patents. It's just not, there's nothing in the structure of the patent world that's going to explain that. I can spend more time on this, but I think I'm going to skip ahead from this. So in other words, if you have to explain this, and we'll come back to this point in a few minutes, actually, or maybe in 20 minutes, we have to explain why there is inter-firm variation in technology within the same country. That's where the clues lie, not in India has the wrong technology, US has the right technology. That's neither a fact, because many firms in India do have the cutting edge technology, and nor is it something that's going to explain nor do we have a theory that explains that fact. Given the particular patterns of technology used, we can't really explain those using the argument that there's a patent that's stopping it. Okay. Let me skip. Now I want to go back. So this is just background, in a sense, just kind of dealing with one particular issue, which I think is interesting to think about and important, but I think is not going to help us explain the data very much, and go back to go back to the old argument. Lucas thought that 45% differences in, if a return of 45% in India was just not plausible, but capital will flow, all the capital from the US will flow to India. That was in fact the title of his paper. Why doesn't all the capital flow from the US to India? That's the title of his paper. So he's exactly, this is not a minor point for him, this is kind of the proof of the pudding. So the answer, now surprisingly, he didn't notice that there's a whole literature which shows that, within the same country, within the same village, there are investment opportunities which seem to have very large differences in rates of return. Capital just doesn't flow for whatever reason, and I think Esther spent some time talking about what the reasons might be. Capital doesn't flow very much, and we kind of know that. Why is that relevant to this conversation at all? Does anyone? What's the connection with the aggregate production function? There's a very close connection.
Maybe knowledge flows through networks of relationships between people, and so does capital. So some opportunities of investment are not known where capital is.
That might very well be true. I was asking a much narrower question, which is, you're giving me a theory of why you may see different rates of return, which I think is perfectly reasonable theory. I was asking a different question. I'm going to spend some time talking about variation in the rate of return on capital. What is the connection between that set of facts and the existence of an aggregate production function? Yeah.
When Japan cannot borrow to finance its firm, so the market cannot reach the optimal.
Correct. So remember, we said that the aggregate production function is kind of based on the construction of that. We're going to construct the aggregate production function by saying, if I given a certain amount of capital, how do I maximize GDP? One way to think about that is what is the condition of efficiency in the use of capital? That's saying that I have used the capital to maximize GDP, right? That claim that I've used the capital to maximize GDP is saying something about the marginal products of capital in all the uses. What does it say? It's equalized. That every use must have the same marginal product of capital, because efficiency in capital use is just saying that in every use we observe in the world, the marginal product should be equalized. So if the marginal products, so in other words, instead of addressing the question of aggregate production function by looking at the aggregate data, we're going to try to look at it through the disaggregated data. We're going to see, is it true that the marginal products are equalized? Okay. Do we believe that the marginal products are equalized? Because if we don't, then in a sense, we are kind of at least halfway done. I'll say why halfway. I said halfway.
Yeah, so just a clarification. So Lucas thought that 45% in India was not plausible, but so observing 45% in India makes Lucas' observation even more plausible. No? Because in a way, he's not even looking at whether there are rates of returns that may possibly explain why there are not such capital returns.
No, I think maybe I'm getting it wrong, but I read it as saying that his argument is it cannot be that the rate, he doesn't observe the return in India. He says it cannot be 45%, but if it had been 45%, all the capital would have left. So it's not 45%. If it is 45%, then in a sense, you have to then say that there is no teeth to that argument. The argument is, if capital never moves, take the extreme world where capital never moves, whoever owns capital never gives it to anyone else. In that world, that argument has no teeth. There is no bite to the point that, interest rate differences are 2000%. That still wouldn't have any bite because the market doesn't function at all. Okay, so what I'm going to do is I'm going to spend some time reviewing the evidence on, on exactly that question, are the marginal products of capital equalized? Before I do that, let me do one thing. Maybe, okay, I'll wait, but remind me to do it. If I don't do it, I am supposed to make an announcement about what the requirement for getting credit in this class are. So, I shouldn't forget it. Okay, let's keep going, because this is more fun than making the announcement. And I can't resist things that are more fun. Okay, so one way to think about the marginal products of capital is that the marginal products of capital are bounded below by the interest rate. You should never pay more than your marginal product of capital. So interest rates, these are some of the interest rates. This is a nominal interest rate. These are nominal interest rates, but the inflation rates are, 10% or 8% or things like that. So if it makes no difference. The rates of return, the real rates are 68%, or if I take 4% per month, that's about 60% per year. You can subtract off 7% inflation. It's going to change anything. These are estimates. These are other things. These are estimates of the marginal product. So these are interest rates. These are estimates of the marginal product, direct estimates. And when you estimate marginal products, these are for medium-sized firms in India. The marginal product of capital is 90%. For these firms, Udry and Anagol estimate the returns in agriculture on capital, and they find about between 50 and 250%. These are from a bunch of, now there's a bunch of randomized control trials where basically, and these are sort of very, very simple exercises. You give firms, you just grant them a certain amount of money and see what happens. So you gift them some money and you see what happens. And the rates of return, in Sri Lanka, the first experiment found returns of 5 to 7% per month. People gasped and said, that's enormous, it can't be true. So they went and did it in a bunch of other countries, and it turned out Sri Lanka is the lowest return country in their sample. So there is, Fafchon did do a similar exercise in Ghana, where he finds 15% a month. In Mexico, they find 20 to 35% per month. So in other words, now these are actually different kinds of numbers, by the way. What we observe, this is the rate of return on, I take a set of firms and I just give them some money. These are returns on firms that demand the money. That's a different, because there's self-selection here. These firms are maybe just the highest return firms might be the ones who are willing to pay it. If capital was sufficiently scarce, they would still be paying that. Other firms might be, just right now not borrowing. But these at least are estimates from not the marginal firm which decides to borrow, but from the average firm in that sector. Because they were not targeted. So when you look at the demand side, you necessarily have to deal with the fact that people who demand capital might have higher returns than everybody else. there's some self-selection there. When you look at the supply side, there is no such thing. I'm just dumping money on you. I didn't target it on anything. I look at the average return. So these are actually more impressive numbers than these. But in any case, the main point is that I could keep going. There's lots and lots of estimates of high returns on capital.
So I have a few questions. First, I believe that from the first part of the class that there is a huge variability in the rate of return observed at the micro level. And second, two related points, questions. Is it possible that such high rates of returns are due to efficient effect, that is, you don't, it's not a net effect, but the fact that you take the market from other less productive competitors, so it would mean that you cannot go from micro to macro with such results, which may call into question some intuitive policy recommendation, and also, are these results only on internal market where there could be eviction, or are they relevant for exportation, for export, stuff like that? That means, are they relevant to analyze really productivity when compared to other countries?
So I would say, let's start with the two parts to your question. One is, from the point of view of, you're asking two, I think, very good questions. One is this mostly about taking business away from someone else? Okay, that's one question you're asking. So do these add up? So if I gave the money to every firm, would I get the same effect? And the second question so that's a question about aggregation. There's also another question which is this, am I misinterpreting this by sort of looking at these numbers? Am I misinterpreting the effective variation in marginal products? So the answer to the second question is no. I think that the correct exercise is to look at, remember, the claim about the aggregate production function is that all marginal products should be equalized. So as long as the marginal products are not equalized, so I didn't say anything about them not being equalized so far, so let's wait on that. But certainly that's not an issue here. On the question of, are these, should I think of this as being the macro return on the investment in the economy? That's just sort of what you're asking. Again, I want to postpone that question a little bit, but let me say one thing. One thing that's not true is that here I don't think there is a lot of business stealing effect. Because what these are tiny, they do actually careful to look at that. These are tiny retailers mostly across, or garment makers, and they make identical things. Like I think in Ghana, these are garment makers that they make tiny, they're tiny tailor shops, and there are thousands and thousands and thousands of them. You give the money to, 50 of them or 100 of them, it doesn't change the price of anything. So I don't think this is a big business stealing problem. So I think they are mindful of that issue, and I don't think that's what's going on here. I think these are really net returns for the economy. Okay, but those are good questions, and I'll certainly try to address your bigger question as I go.